Go ahead and get started. Thanks for joining today's room with mortgage market updates. My name is Joseph Flannery. I lead the mortgage division here at Radius called LoanDesk, and just want to go over a couple updates with mortgages. So first, you'll find that often consumers will ask, "Hey, what's the interest rate? Are interest rates falling? Or are they not falling?" And I always like to start with like what's the data point to best predict whether or not interest rates are falling or rising, um, because most borrowers are using the Fed funds rate as kind of the barometer as to whether or not interest rates are going up or down. So you can have, and what the Fed funds rate is that's the one that gets all the news. So, for example, the Fed funds rate, they held it steady in the last meeting of the year. But when they did that announcement, they indicated that there's potentially 3 rate cuts on the horizon in 2024 of a 0.25% each in 2024. So that sent stocks up, bond yields down, and that's actually what drove mortgage interest rates to change. So it's actually not the Fed funds rate. The Fed funds rate remained unchanged. So if you want to know what's going on with mortgage rates, the best determining factor is actually a treasury yield, and specifically the 10-year treasury yield. So how do you track that? Well, let me share a screen. So when I first joined the mortgage business um, in 2011, I remember sitting in the capital markets department, and I was just trying to learn as much as I could. And there's a really smart guy. He was like, "Yeah, it's the TNX stock ticker." And so ever since then, since 2011, I have woken up and I have looked at the TNX stock ticker. And what he was telling me is basically his income is kind of inverse of the TNX. So as the treasury yields, as the TNX goes down, his income goes up because rates are going down. So there's more mortgage activity. As the TNX goes up, his income goes down. So he was telling me that he actually has like a inverse position with TNX, so that basically he's hedged. I don't really do that, but yeah, that was let's see, in 2011 when I first learned it. So you can see here that the TNX, this is the 10-year Treasury bond. So today, if you wanted to get a bond from the US government, which is considered the most secure and safest investment that exists, is a US Treasury bond. You could get a 3.922% interest rate. So that's kind of like the yield that you're getting on your 10 years. So it's basically almost 4% that you're getting. So now imagine if you're a lender, let's say you've got millions of dollars in the bank, and someone comes to you and says, "Hey, I want a 10-year mortgage." So what would you set the interest rate to be if you wanted a 10-year mortgage? Now, you can get risk-free from the US government, never defaulted, 3.922% today. So what would you set your mortgage rate if you were just a private lender? Well, you'd likely set it higher than the US Treasury bond, because why would when you set a mortgage, there's a chance, even if a person has terrific income and assets, there's a chance that that borrower doesn't pay and they default on the mortgage, and now you're not collecting and have to go through the whole foreclosure process. And if you're a private lender, and basically you just got burned on that deal. So you got a risk-free option here at 3.922. So what's the yield spread that you need to earn to make it worth your while? And essentially, this is what Fannie Mae and Freddie Mac and Ginnie Mae does. And if you don't know what those institutions are, this is really important because they're essentially the liquidity for the housing market. So 90% of the mortgages that are originated in the United States get sold to one of those three enterprises. Fannie Mae and Freddie Mac, they do conventional loans. So they have an underwriting guidelines for anything conventional conforming. Ginnie Mae, they do
It's
FHA,
my car not gonna be ready today.
USDA, and VA loans. So that's actually a wholly government-owned entity. And the reason why the 10-year yield is actually the better treasury yield to track is because the average length of holding a mortgage is closer to 10 years than it is to 30 years because it's even less than 10 because people may end up refinancing, they may end up selling and buying a new home. So the 10-year yield is offering this barometer as to what's going on with mortgage rates. So this is what every day I wake up, I look at the 10-year yield because it tells me what's going to happen with rates before the lenders then set the price. So what the capital markets team at Fannie and Freddie, they then look at the 10-year yield and then they set their prices, and then you got the wholesale lenders and retail lenders, and everyone's setting their prices based on that. Now there is margin, a lender can charge more if they want to. They can have a gain on sale margin of 5%, where some lenders have a gain on sale margin of 2%. And that's why it's super important to shop around. So let's just look in the last year, what's going on. So without even looking at like a mortgage interest rate chart, you can already see what's going on with mortgage interest rates just by following the 10-year yield. So you can see here that the 10-year yield almost clipped 5%. Boy, it got like as close as you could possibly get, 4.997. Didn't quite get to that 5%. But look at what's going on since October 24th. As fast as mortgage rates rose, like, when we're seeing that kind of activity coming down, like a full 1% off the treasury yield has gone down. And so this creates a educational opportunity with clients because mortgage rates, the velocity of mortgage rates changing often doesn't get digested into the housing market as fast as the changes occur. Because people are listing their homes, it's not so fluid like it is with a rate. But the same people who maybe got pre-approved at like 7.5%, now they're probably at like 6.5, maybe even lower. We're even seeing some rates for well-qualified clients, if they're willing to pay some origination points, we're seeing rates in the fives. So that's what's going on with rates today, and potentially could go even lower because, again, Fed funds have announced in their dot plot they potentially see 3 rate cuts. That will push likely bond yields to go lower. Investors will put maybe more money in the stock market, and you'll see that digested into rates. So I'm gonna just pause there, see if any questions about like treasury yields, why treasury yields impact mortgage rates. All right.
Hey, Joseph.
So,
Joseph, I
hey,
have a
Brandon.
question.
Yeah.
What's the typical margin on it? Say it's a 4% treasury yield, and you're a bank, a lender, and you're trying to figure out a margin above that to assume the additional risk. Is there some type of guideline that people go by?
Yeah. So it's kind of a two-part question because you have basically, let's say the loan is a conforming loan and it gets sold to Fannie Mae and Freddie Mac. So they're going to set their margins. Like if we were, let's say LoanDesk was a direct seller to Fannie Mae, we're basically selling and they will tell us what they're paying. So it might be par pricing today at 6.25 for a 780 credit score. So meaning it's like 100. You're not that's exactly where par pricing is. One of the things that's nice is now like more lenders, because after the refi boom, went public, so their margins are public information. So for example, the gain on sale margin for UWM, it fluctuates, but is around 1% is what their gain on sale margin. So for Fannie Mae, they're essentially I would say a best case scenario is like, you could think about this as like, usually with the mortgage rates are going to be about like 2.5% higher than the treasury yield. That I would say that's kind of the best case. And another way to kind of like keep an eye on rates is like Mortgage News Daily. This is free. You can see what's going on with mortgage rates, and where kind of rates are at. We try to like take this data and share it as well, and it has a 15-year. But the way that the news outlets are looking at mortgage rates is that they're going off what Freddie Mac they publish this every Thursday. So you can actually see current mortgage rates since, it looks like, since 1971. And this is public information. So Freddie Mac, you just put Freddie Mac mortgage rates. And it's a little dated because it's Thursday, so you can see the 12/14 is the last date, and this is why the news media is always 1 week behind what's actually going on with mortgage rates, is because they're going off this Freddie Mac public data, but the data doesn't come out until Thursday. So the story is usually 1 week behind, which is why I like to always like let clients know, especially if they're in pre-approved and they're shopping. Let's say if there's a big drop in rate on like a Friday or Monday or Tuesday, I'm like, hey, you're probably going to hear about this next week, but rates are actually falling right now because that's what we're seeing. But so you can see here, Freddie Mac, the average rate that Freddie Mac was originating on for the week ending on Thursday, October 26th, from mortgage bankers is 7.79%. And now it's at 6.95. So like all these people who got mortgages, like they may say, oh, we're kicking ourselves, but they should be happy because guess what? They can now refinance their mortgage. If they want to wait until they make 6 payments, which is usually what most lenders will require to refi if they're avoiding kind of like any early payoff default to that lender. So if let's say they want to refinance their mortgage, big opportunity for that 7.79 person, whoever, some people took rates in the 8s. So this is a great tracker. I mean, you can see like what the heck happened, over the last 5 years, and how rates were obviously, like, I guess the low point was right around here. January of 2021 was the low point for mortgage rates. So great tracker to use. I actually use this this link in a lot of my marketing content. Like, so I don't know if any of you post on social media, but sometimes I'll actually just post this link and I'll do like a screen share, or sorry, screenshot of like the graph, and then I'll put the link as like the back in. And so I'm always looking to post content that is educational and not like self promotion. But Brandon, was yeah, hopefully that answer the question. But that's where we're at with rates right now. Refinance opportunity. So this is actually conforming rates. Government rates are always a little bit lower than the conforming rates. So right now we're seeing FHA streamlined VA IRRRLs in the high 5s. So if you know any veterans that have a rate in the 6s or even the 7s, like please put me in touch with them, because they can save some money. All right, I'll pause there. And then just actually, I've never even downloaded this spreadsheet, but you can even get really particular. This is opening up on a new window, all the historical data of mortgage rates. And then you could tell somebody, it's like, hey, in I don't even know if I can share this. So it gives you all the way back to 1971. So you can say, hey, in 1990 and in December, so this time in 1991, the interest rate was 8.49%. And the one thing I will say about the Freddie Mac is this usually will assume with origination costs. So if you're wondering, like, if you're ever comparing like LoanDesk mortgage options of like, hey, are we undercutting the market? This is kind of like what to go off, because here we can see for this week. Let's just go to this week. I think they give you what the points are. Yeah, I guess it's just, but usually this includes points with what they show here. So yeah, that's the headline. Mortgage rates drop below 7%. So exciting news. Great reason to circle back. That coupled with conforming loan limits rising to 766,000. So if you have anybody who is like pre-approved at 700,000, let's say that's what the loan amount that they're pre-approved for, get back in touch with their mortgage loan officer. They should be pre-approved now for 766 when you factor in the drop in rates and the new conforming loan limit. But yeah, that's all I have for the mortgage market update. Anybody else have anything to add? Joel?
No, I just wanted to wish everyone a happy holidays. I know we often overlook, this is kind of besides mortgage and real estate, but we often overlook a lot of our blessings. Just very fortunate, that we're, even with this market, that we're able to transact, do deals, work with the people that we're working with. In terms of connection, I know for this group right here, we have a couple of people that are a part of our dual licensing program. I definitely want to connect with some of you guys just to talk about some last minute adjustments that we're doing. So I'll contact you guys all very shortly.
Yeah. Yeah, all for the positive. And so this like where my mind goes when I see this drop, so like, what's going on is refinances. Refinance. And I did a whole segment last week on when it makes sense to refinance. And just to do a short summary, when you can lower your rate and you get a lender credit to cover all the closing costs, so it's a zero cost refinance, there's really no reason not to do it. Now, you may choose to actually get to not do a zero cost refinance. Maybe you want to go for a even lower rate and pay some closing costs. And usually then, if you're calculating that, if you can recoup the closing costs within 1 year, then it usually makes sense. And you have to factor in also that you're restarting the clock on the term. So make sure that it's apples to apples when looking at the savings. But that's where my mind goes, is refinances. So as a home owner, I believe one of the biggest value adds is the ability to refinance. So if you're a tenant, you're pretty much stuck paying that rent, and most likely that rent's going to go up and you don't really have a whole lot of leverage. But if you're a homeowner, it's almost like, today can I lower my payment? Today can I lower my payment? It's like, if you think about it, every day you could potentially lower your payment. Now, you obviously don't want to refinance every day. You want to do it when it benefits you. And that was the whole topic of last week. So if you know homeowners that have rates in the sevens, they may be apprehensive to refinance because they're like, hey, I just got this mortgage 7 months ago. Shouldn't I make more payments? Well, my response to that is, it doesn't really matter. Even if you paid points to get that rate in the 7, which I would have advised you not to do because likely you would have had a refinance opportunity. If you can lower your rate and get a credit to cover the cost, it always makes sense to refinance. And if you don't want to restart the clock at 30-year fix, we work with lenders that will set up your loan term to be a odd number years. So it could be like a 29-year fixed mortgage. So now your payment is lower, your rate is lower, and you're paying off your mortgage faster than what you were, if you had only making 7 months of payment. So it's this whole education requirement that to me also fits in with working with like first-time home buyers, because they're when you talk to somebody who's buying a home, and especially true in California, but probably most in most parts of the country, their monthly like cash out for housing is going to be higher, and I always have to walk them through the itemization of that, like putting, yes, it's higher, but you're putting money towards principal. That's not a cash out. That's an investment. It's like you're depositing money into the bank if you pay towards principal. And if you could pay extra, then you're going to get ahead on the amortization schedule, and more money is deposited money into the bank. And then the second thing, so that's number one, why the payment is higher. So, make sure, and of course, owning your home is going to be higher because you're paying off the home. And then the second thing is you have this ability to refi. Like just look at what's gone on in the last 10 years. Like look what's gone on, historically, all these cycles, So as a homeowner, if you are not taking advantage of paying less money on your mortgage, you're really missing out on what my opinion is like one of the key benefits of homeownership. So as real estate agents, the reason why I think this matters is because you may hit challenges to take someone who's renting a place for $3,000, and then they're buying a place that's going to require between principal, interest, taxes, insurance, maybe $6,000. Like that's an affordability challenge of maybe why that person doesn't buy that home. But that's why I always have to walk them through. Well, the payment towards your principal gets subtracted out of it. So now, and as you pay more, the more goes towards principal. So let's say if it's $500 towards principal, well, now it's only $5,500 because principal is depositing money in the bank. And then you also have this potential to lower your monthly payment in the future should the opportunity arise. So what you pay today could be less in the future. And then lastly, if rates fall, it's very likely that home prices will increase because there'll be more competition to buy those homes. So this is all just it's at the end of the day, it's the buyer's decision. But I think sometimes if they're more educated about the payment and not just looking at it, $3,000 to $6,000, they'll be more likely to say like, okay, this does align with my goals, even though I'm paying a lot more for my housing. All right, I will stop there. By the way, if anybody has suggestions for these mortgage talks, like I'm certainly all ears, and if anyone would like to host the mortgage updates, I'm certainly game for that too, or co-host. So thank you all for joining, and I am available if you guys have any questions. Feel free to email, call, text. Love working with home buyers. Love working with agents. All right, thank you all.